Hello and welcome to Target Business English classes. My name is Jalil and I will be your teacher today. Nowadays, many people work on international companies and have to report the financial results in English to the headquarters. Now for this reason, we're going to help you improve the vocabulary used in these situations. Okay? So each year an annual report is produced with three key sets of figures. Now finance people, you will know this very well because we have a profit and loss account, a balance sheet and also a cash flow statement. And every company will create one of these. So in some countries like the United States, the results are published every quarter. A quarter, 3 months, every 3 months, okay? And in this class, we're going to focus on the profit and loss account, or the income statement as it is called in the United States. In order to make the understanding easier, we will first explain important terms, and then we'll give an example on how this report is done. So, nothing more to do, let's get down to business. Okay? So, the profit and loss account is exactly what it says. It records the money a company makes and a company loses during a specific reported period using the accruals principle. The accruals principle means that events in a particular reporting period, for example, the sales of goods, are recorded in that period and not when money is received. Okay, so we're looking at the sales of goods. So now we need to look at cost. The cost of goods sold is the cost of materials used to produce the products and labor. Okay? Selling and general expenses are the costs related to making those sales. For example, employee salaries, overheads, rent for buildings, and any cost the company incurs while applying this cost mechanism. Now, depreciation is not an actual sum of money paid out, but it's very important because depreciation shows in the accounts to allow for the way that machinery wears out becomes old and declines, so the value decreases over time and will have to be replaced. So depreciation, very important. Machines lose value, guys. So we move on to the interest payable. It's a sum expressed as a percentage of money borrowed or to be paid over a given period of time. So we can think about it like this. So from a bank, you take out money and that bank puts an interest payment on it. The interest payment might be the sum of 1% to 10%. So imagine you have $100 and you put an interest payable of 10% on that $100, okay? So 10% of $100 is going to be 110. So when you repay that money back, you have to pay 110 back. Interest payable, okay? That is the interest, the amount you pay back on top of the money that you owe. Earnings are the amount of profit that a company produces during a specific period. So these are things we like. Earnings, the money the company earns. Sometimes it can be a profit and sometimes it can be a loss. Okay? The dividends are a sum of money paid out to the shareholders of a corporation through the earnings. Now a dividend is a little bit different from share equity. Why? Because a dividend is the chosen amount to pay the shareholders, not the full amount of the value of the share. So look out for that one. Okay? Taking a look at the cost of goods sold is also important. So we would call that the COGS, cost of goods sold. So let's try and put this all into a context. Let's use an example, okay? We're going to use an advertising agency. Now, an advertising agency would be an agency which uses propaganda and creates propaganda for other companies. So, the sales for this company in general, they're going to come from books, advertising in books, magazine advertising, and also television advertising. These would be the main sales of this company. And so, they're probably going to record this over a quarterly period. And that's 3 months, okay? So, the money they receive from sales minus the cost of goods sold would be their sales for that period, okay? Then after, we would apply the selling and general expenses along with depreciation to give us the operating profit. So that's the use of taking away selling and general expenses connected to depreciation, which leaves operating profit. Now after that, this interest payable is subtracted. Remember the interest payable? The money on loans or any money borrowed, which we have to pay as an extra. And then we will have our profit on the ordinary activities before tax or as it's called, pre-tax profit. Just of a note, okay? In the United Kingdom, sales would be referred to as turnover, okay? So when we use sales in the US, in the UK we would use turnover, okay? Now from that general pre-tax profit, earnings or profit after tax would be applied after we take the tax off. And after the tax is taken off, then we can pay the shareholders, our investors. They would receive their dividend. Remember that dividend? The money from the earnings paid to the investors, our shareholders. So we can see that dividends are paid per share. And remember, dividends are different to earnings per share because a dividend is what the company chooses to give. Now, obviously, when you have bad business, a company may decide to omit, pass, or skip dividends. And by skipping dividends, the company tries to retain money, and this might create problems with the shareholders. So sometimes companies tell the board of directors or tell the shareholders, I'm sorry, this year we're not going to use a dividend because we are going to reinvest into our company. And companies usually retain their earnings. So these are retained earnings or a reserve of cash. So that's all for today, guys. Next class we will focus on the balance sheet, so don't miss that one, okay? The balance sheet. Today was profit and loss. So thank you for watching our class, and we'll be looking forward to seeing you next time. Thank you so much.